I'd like to bring Ralph in, because the first thing that comes to my mind as a business leader is when I look at the auto-enrollment of pensions, not just for our own business, but obviously we're recruiting permanent employees for companies around the country, many of whom will have a defined contribution pension scheme, maybe 5% by the employee, 5% by the employer, or maybe a 2-for-1 matched contribution scheme. And how's auto-enrollment going to affect companies that are already operating a scheme like that?
Yeah, it's a great question, Donal. Like, I suppose it's interesting coming off what Paul has just spoken about the EWSS, which is, very real and a deadline kind of 21 days away. Whereas this, I think auto-enrollment, originally on track for implementation in 2006. So that's not going too well. I guess my answer would be, those kinds of companies that you're talking about probably have guessed the answer here, which is that they can offer superior benefits with what's already out there. And, you'd probably be unwise to rely on auto-enrollment to solve either your organization's pension problems or your personal ones, so that's probably the first part of the answer. I guess the second thing is that I think those kinds of organizations which have already looked at this stuff and put something in place probably have an advantage over businesses that when it eventually does arrive, implement an auto-enrollment based pension solution. Like, I guess what we're saying to a lot of our clients is that you're at risk if you wait until the last moment on this stuff of looking like you're doing the bare minimum because you had to, and that's a difficult message to sell to any member of staff, right?
Yeah. Paula, the other thing that I didn't say when we did your introduction is that in your former life, you did own and operate a recruitment business. So I suppose, can I come back to you to ask you if you think about the auto-enrollment from a recruitment company's perspective, say, for example, where they might have hundreds of temporary agency workers. How do you see that impacting those type of organizations?
Yeah, that's a good question. Donal, I think, and I was thinking about this as Ralph was answering your question there, that we run many payrolls, hundreds of payrolls, but some very large organizations. And those large organizations very often have high staff turnover. They have a lot of individuals working, being transient, international, and so on and so forth. So for those types of organizations, and recruitment comes into that, because if you have high levels of temps starting, stopping, and high turnover and so forth, the auto-enrollment is the way to go. You're not going to be offering a temp that's working for 6 weeks your contribution pension and so on. So, after 6 months with the company, there's going to be, I'm not 100% sure of the rules, but after 13 weeks, the pension will kick in. And from that point of view, then if you have very short-term temps, it won't impact you, but it will impact you once you have some steady temps. So I would say that that's where a lot of the companies. Now, Ralph might answer the question in terms of having two pension schemes. I know we do have companies in the north, in the UK, that we run the auto-enrollment, but yet their management team, their office team, and their exec team are all on a separate pension scheme. So it's not that it's a one for all. As far as I'm aware, that's the way it works in the UK and Northern Ireland. I'm just not 100% sure how it'll work in Ireland.
Yeah, I think that's right, Paula. Like, I think what you're putting your finger on is that there's a lot that still remains to be thought through on this. Like, as matters stand, kind of every few months we get a government announcement. The most recent was at the end of March. So, kind of 5 months have gone by after that flurry. But, it stretches credulity for me to think that the 1 million odd non-pensioned employed workers in Ireland are all going to find themselves enrolled in an auto-enrollment pension on the 1st of January 2024. For one thing, it's a bank holiday. So, there's a lot of wood to chop between now and then. But I think, one of the things we see as a risk is that, like you say, there's kind of a two-tier, maybe we've already got a two-tier pension system between public and private, but there's a kind of a second tier of pension where if I'm that temp, as you say, who the auto enrollment pension attaches to them as an individual, and they will want to bring that pension pot from employment to employment over the years. Whereas, as you say, Donal, like someone who's already running a group pension, then they hire somebody new and they're on an auto enrollment scheme. Do they pause that and contribute to the group one? How does that all? That might be financially beneficial, but it's going to create admin around that, and I think we're going to get a sixth state agency governing pensions to administer all that, which is yet to be formed. So there's plenty to be kind of thought out. I suppose the key message to employers is this is in a cost pressured environment. As matters stand, we should all be adding 1.5% to our people budget if we don't already pay employer contributions into pensions.
Super. I think just to touch on the point you made there, Ralph, we have a lot of business owners who are on the webinar today. So I probably wanted to touch on a little bit about wealth management for business owners. So from your perspective, what do you see as the key differences in terms of wealth generation for a business owner versus people that are, developing corporate careers or working in the public sector?
Yeah, I suppose the key difference is, like, if you form and run your own business, there are good years and bad years, and your earnings profile is probably lumpy. And like even on a psychological level, you can find all your peers who have kept on that corporate ladder, perhaps are getting richer at a point when you're investing in growth. So it has been the case that the pension system recognised that, and through what a lot of people would know as executive pensions or single member pensions, it was able to put in kind of one-off six-figure sums into pensions, business owners, that kind of thing. Now, the second key change, I suppose, that's come from through regulation, aside from auto enrollment, the second key change this year is that the Pensions Authority issued a release saying, they no longer viewed these as regulatorily compliant, and to the extent they were unhappy about that, would take steps up to and including prosecution of pension trustees if they weren't kind of brought into shape. And as you can imagine, that scared everybody. And since around June, it's not been possible to open those kinds of pensions where you can put off that you can put in one-off lump sums, I guess. So the key thing, people in our industry been going around looking for a solution for that pretty much since June. So I suppose what I would say is, if that is a nasty shock to anyone listening in today, I think there is some positive change to come there. And, within a matter of weeks, really, we are going to see something similar to what used to be capable of being done. So large one-off contributions into pensions through a slightly different kind of pension arrangement. And I guess the other thing I'd say is one of the positive things that's come of this, and this dovetails with the auto enrollment piece, is the pensions industry has responded by making it possible to form company pensions, like group pensions, for as few as 3 members. So if you're sitting there as a member of a management team, even 3 months ago, to have gone to the big pension companies and formed one of that for if you like, a smallish group of people, would not have been economic. That's changing. And it really, even if one is waiting for auto enrollment to kind of straighten out the majority of one's workforce, just consider, it's often easier and cheaper than you think to put in a benefits package for your team, and in particular, if there are key people amongst that you would like to be, for either retention reasons or as part of the core team, a lot can still be done there. So that would be my message today.
And I'll open this question to both of you as business owners and as specialists in the area. One of the questions that often comes from owner managers is around the level of net assets to leave in a business versus so that you've got cash flow to survive the difficult periods, so that you've got working capital to invest, versus, distribution of dividends at year end, etc. So I might just open that to just get your views on, what do you think are the pros and cons of leaving a lot of, I suppose, potential wealth in a business versus having it there for working capital versus dividend distribution, etc.
I'll jump in quick there. I think that it very much depends on the size of the company. If you've got a small recruitment company and they're not doing a lot of temping and their turnover is, $500,000 a year, the accumulated wealth in that organization will be significantly different to a CPL or another very large organization, in the industry. So I think the structure is hugely important. This country is predominantly SME organizations, and there's a lot of SMEs in the recruitment industry. So I suppose I would be saying to those smaller organizations to accumulate a bit of wealth so that when they're exiting, the principals are exiting the business, whether they sell, whether, they have a management team coming up, whatever they're doing. First thing to look at, in my view, would be entrepreneur relief and retirement relief, depending on the age. So those are the first two things for the smaller organizations. For the large corporates, I go to one of the big four and get some really good advice.
Well, as someone who left the big four once, I'm sure they'd be delighted to hear that. I guess that sounds like really good and relevant advice. From my perspective, I would say, have a plan. It is a lot easier to invest cash off balance sheet than, pay tax taking it out and have to put it in as a loan later, for sure. But by the same token, this industry tends to be relatively capital light. Your CapEx, as it were, tends to be in people, which is, tends to often not be a kind of large upfront cost, but it's invested over time. So can you finance that out of cash flow? Because if you can, look, life's unpredictable. And there are lots of people out there who have kind of, predicated a great future on their business. But it's important to, get paid along the way as well. And that might even come at the cost of a bit of, don't let the tax tail wag the kind of overall wealth dog. So it's, if you probably find many people on this session, their wealth is tied up in their house and their business, and should you be creating a third pillar that supports you? And just think through the scenarios. What would happen if something happened to me or someone in my family? Go through the what ifs, and there are generally things you can do to plan around that. It might be, for example, you don't want to put money into your pension just now, but a lot of people are therefore insuring their lives for a significant lump sum within the company, because then, if you don't have those years that you thought you would have to earn money to fill your pension, there's some insurance in place. So there are simple things you can do to kind of reflect the fact that your earnings profile as an entrepreneur or business owner will be less predictable.
What top tips have you got, Ralph, for people thinking about protecting their self along the journey, protecting their wealth for challenges that may arise like that?
Well, I suppose at first glance, I'd say, think about those kind of pockets of wealth. Where are they and where do you want to build them up? But then, I suppose we look at pensions and we think, gosh, people panic. I haven't built up my pension. But actually, the good thing about that is that you can do that over many years. But there are also clever things you can do so that you can ensure that, if you're not working, an insurance plan is paying into your pension and building up your pension. Because we think, if we take time out of the workforce, that obviously our income stops, but what also stops is the money going into our pension. So there are things like that. It's like the little nuances around the edge can make a material difference. I think, Paula, you've already put your finger on, the key reliefs. If you're working towards an exit, it takes time to exit a business. And there's a lot of planning around that. So, from tax planning to the shape of your workforce, guess what? Everyone selling their business thinks it's worth more than the people buying their business, right? So how are you going to justify that? How are you going to evidence that the value resides in the infrastructure and the team that you've built around you, so that you're not locked in for 5 years post-transaction? It's that kind of thing. So I would say, have a plan to evolve your business, because it's probably the case that when you're extracting the wealth from it, the real wealth, that's not going to be, your business is going to look and feel quite different than it does at the point now when you're thinking that through. So you kind of almost, yes, you've got your financial projections, but you also need to consider the evolution of your organization and what it'll look like on the day you're shaking hands.
And what's the tax treatment if we're thinking about those tough scenarios where there's a bereavement or something like that? If you think about a business owner who's potentially on this call today, who has a defined contribution pension scheme, maybe they've got death and service benefit of 4 times salary or something like that. What is the treatment of the value of their pension and bereavement usually?
Look, if I ever get the opportunity to dodge a tax question because there's somebody who's a specialist in this, I take it. But I guess joking aside, the overall attempt here is to kind of respect the wishes of the person and have that money find its way to the beneficiary. So I suppose something we've not said here, and it's a bit like pensions, only worse. But everyone knows they should have one, but write a will. It makes a difference in terms of who gets what and what tax they pay. It can be different if there are minors, different rates apply, all that kind of thing, but in principle, I suppose the aim is, say, if there's a surviving spouse, that pension wealth will move across in a sort of seamless fashion. Paula, you can probably elaborate with more precision.
Not really, actually. Pensions would not be our expertise, all right, although we would give some guidance to clients. And just as you said, the basics are so important. Having that will, we know clients that it's in probate for 5, 6, 7 years, and there's arguments within families and so on. So, that basic core setup and planning, as you have advocated, Ralph, is critically important. Yeah. And getting good advice, from people that know what they're talking about, I think that's very important.
And I think if you're in a business as well that has multiple shareholders, it's about having robust shareholder agreements, key person insurance in place to deal with what happens to your shares if there is a bereavement for one of the shareholders. So lots of stuff to think about there. Not the fun stuff, but definitely important to look at it